Hello everyone. That's very loud. I'm Ed from Barbour ABI. If you haven't heard of Barbour ABI, we consider ourselves, and I think we are, UK market leaders in the built environment. So we basically do market research into construction, and the way we do that is we collect all planning applications and then we do supplementary research into those planning applications. We work with about 3,000 customers. They're pretty much all contractors, subcontractors, but also people that do all of the interiors of buildings as well. We also work with lots of banks, investment houses, hoteliers, you name it, there's probably somebody out there somewhere using our data for something a little bit weird. We're really proud to be associated with the UK government and also the ONS as well, providing them with some of the key data that they look at. So, what am I going to be talking about? I'm basically going to be talking about some general trends first of all, so big picture stuff, and then we'll gradually sort of whittle down into some construction specific metrics, and then we'll take a look at some residential stuff at the end. So just starting off with some of the big macro factors that are occurring that would overlap with the previous speaker's presentation. So from a UK GDP perspective, this year it's expecting to finish around 1.2%. Next year it's being forecast to be around 1%. So modest growth, but you have to think about that in the sense of it's underpinned by weak productivity. So the UK as a nation historically has kind of produced its way to GDP growth. That's not something that's occurring at the moment and probably won't for some time. You also have to think about it in the context of high interest. We're talking about different relative periods, but high interest rates at the moment. And then yesterday really set a tone of fiscal responsibility, I think. But with fiscal responsibility, obviously there's less speculation, less investment, so probably less growth. Consumer confidence, as I say, GFK. Anyone know or heard of GFK? It's like the big provider of consumer confidence as a measure. It's a number that can be positive or negative. It's very negative at the moment. Basically, consumer confidence is a reflection of the fact that the cost of living crisis has decimated a lot of our kind of pockets, our pay packets, as it were. It's expected, consumer confidence is expected to improve next year, but it's still going to be a very negative number. So it's just a reflection of the fact of how hard times are at the moment. From an unemployment perspective, unfortunately, that is expected to increase going into next year, while also the number of vacancies is expected to continue to creep down as well. We're seeing lots of manufacturing continuing to leave the UK at the moment, and obviously AI is really starting to ramp up. We're hearing quite frequently in the news, many thousands of jobs each day being axed in big tech companies where AI is coming in and supposedly doing a better job. From an inflation perspective, roughly 4% this year, probably 2.5% next year. That's being largely driven by supply chain, so the cost of goods being more expensive year on year. It's less to do with energy and rent next year than it was this year, so those two things really stabilising. I've got what I think is a very surprising number. So if you took the cost of goods today to get back to those same goods, the same cost of those goods pre-COVID, you'd need a 30% reduction in the cost of goods. So it just goes to, and it's way higher in construction, by the way, it's closer to 50%. Just goes to show the difficulty that lots of people are facing into, both in and outside of construction, but construction is really magnified. From a base interest perspective, that's expected to continue to creep down. It's obviously been reduced very slowly, and the intention there is to ensure that inflation doesn't start roaring again. 3.5% obviously isn't high compared to pre-2008 levels when I was not even at university, but it is high compared to 2009 to 2021 levels. So, it's all about context really, but 3.5% is kind of, I suppose, considered high at the moment. It's obviously there to try and limit demand, control inflation, but I would also argue that it's stifling construction at the moment. So there's a lot of people that are waiting for inflation and base interest to come under further control or even go back. And then finally, the final box is to do with foreign investment. So this year we've seen foreign investment go down. The pound actually rebounded yesterday, and I think a budget setting out kind of a lot of fiscal responsibility is quite a decent thing to have done, although I agree it's probably more about internal politics than attempting to kind of turn the country around at the moment. Obviously time will tell whether the UK remains a kind of a favourable area to invest in externally. A couple of very construction-specific macro factors that I look at quite frequently. So the first one is to do with workforce in construction. So the construction workforce has seen a 16.4% reduction in the number of people working in it from 2019 to 2025. So, call it 20%, 15%, somewhere in between, a massive reduction in the number of people working in construction. So where have they gone? Well, COVID displaced a lot of people out of construction. We stopped building for a short period, and quite a lot of people couldn't weather the storm, so to speak. There's obviously been a lot of insolvencies in construction as well. The general economy just isn't particularly favourable at the moment for building. And obviously I don't know if you've heard the kind of the demographic wave description that's occurring in construction at the moment. The UK construction industry massively over-indexes on people who are slightly older, simply because of the nature of the business. So we've got this wave effect where, a low number of young people, but a gradually increasing number of older people, they are going to crash out into retirement, and rightly so. But when that happens, we're going to have an even bigger reduction in the workforce. When you've got an ageing workforce, what you want to do is you want to top it up at the bottom end with loads of young, eager people. And unfortunately, while we are successfully getting about 40,000 apprentices into construction each year, we see a churn rate of about 47%. So you get 40,000 in, call it 20,000 out the back door a few years later because they don't enjoy the industry or they have got other goals. Again, it's painting quite a bleak picture, unfortunately. And then the final point, I refer to it as regulatory bloat, but I'll give you two examples that will hopefully kind of get you on board with what I'm talking about. So the first one would be building safety. I'm not debating it's the right thing we should be doing as an industry. What happened for that bill to come into fruition was awful, and we absolutely needed to do something about that. But if you look at the amount of I suppose lost revenues and also time delay that's happening because of the Building Safety Act and how poorly it's been implemented, which I'll talk about in a few slides' time, you just see that the UK has probably got a few things wrong in construction at the moment. And the second thing I would talk about is the Lower Thames crossing. So I think we're about £2 billion into that at the moment, and we don't have a Lower Thames crossing. And about 200 million of that £2 billion is just paper peddling. There's my planning application. Thank you very much for taking my planning application. This part's wrong. Can you redo it? The cycle goes on. I would compare that to the longest underground road tunnel in the world that already exists in Lardal in Norway. It was built and planned for less than £200 million. Yeah, so we've probably got something not quite right in UK construction, unfortunately. So it's worth giving that some thought if you have any influence in the world. Looking at a few kind of construction-specific statistics. So this chart here it's an indexed chart. So it's not actual repair and maintenance and improvement or new output value. It's indexed, so it's basically effectively a percentage. Both of the new work and repair and maintenance lines are indexed against themselves just before we had the pandemic. So that line down roughly the middle of the chart is roughly when the pandemic happened, and you can see that construction and repair and maintenance kind of dropped off the face of the earth, although there was still some going on, and then it's gradually come back. But what this chart is really highlighting is if you look at this end of the chart, and sorry if you're looking at the one at the back, some of the screens at the back of the room, if you look at the left of the chart and look at the right of the chart, you can see that following periods of kind of economic blips, is probably the best way to put it, RMI typically does kind of creep ahead of new work, and then gradually the first time that happened, so in 2008, we had that divergence, and then they gradually came back to just before the pandemic, where there was that big deviation again, and that big deviation has only gotten bigger. So I thought it would probably be of interest for you all to have a little look about what's going on and why is RMI, so that's specifically repair, maintenance and improvement works rather than new work. So why is RMI really starting to ramp up and outstrip new work? So really there's probably five groups of things that I would talk about. So the first one would be COVID. So I don't know how many of you fall into this bracket, but I personally know a lot of people that very much improved rather than moved. So we're talking about offices at home or out in the garden. We're talking about extensions. We're talking about solar panels on the roof, heat pumps at the side of your house. All of those types of things happened in spades during COVID. I think some people felt like they had more cash in their pocket. They might have preferred to have saved it now, but back then I think people were taking the opportunity to do that type of work. But at the same time, there was obviously less new builds, and inflation was running riot and has really eroded a lot of the potential profit that people were able to make and are able to make now. So really COVID has created this climate where improving what you have rather than trying to build new has become more favourable. Policy and regulations, there's a massive shortage of people in positions, in regulatory positions, so applications not getting approved. If you want to do something new, it needs to be approved. We're seeing massive delays and backlogs. So again, it's just not lending itself to new work, and it's really allowing RMI to continue to propel ahead simply because RMI doesn't always need an application. There's a huge focus from the government around retrofitting and net zero, and that very much lends itself to looking at our existing estate rather than building new estate. From an inflation and rate perspective, so large developments obviously carry really large margin risks, whereas RMI is just much less sensitive to it, so less affected by that. So that's more of a neutral impact for RMI, but a massive drag on new work. From a public spending perspective, obviously we've seen it yesterday, a big fiscal tightening, which subsequently means less speculation, less appetite to do new work, whereas there is long-standing and established RMI schemes around schools and hospitals and many others that are going to continue to go ahead. So again, that just propels RMI up the chart while new work continues to kind of dawdle. And then from a sustainability perspective, so it's all about extending the life of existing estate. That's a big trend that we're seeing at the moment, and building a circular economy rather than looking to do anything new. So the implications of RMI outpacing new work, I won't labour these points too much, but basically the way I see it is that the composition of the market will probably see some changes. So we might see some consolidation in bigger entities while smaller enterprises are able to scoop up more of the RMI work. Subsequently, we'll probably see a smaller pipeline, and that's something that we're seeing at the moment with a decline in applications year over year over year. And also probably a steadier workload, but with smaller and lower margins. From a contractor strategy perspective, the tier ones, we're seeing a shift in them doing more and more RMI work or bidding for more and more substantial RMI work. And we've actually seen some asset management models coming into the market as well, where people are looking to manage estates rather than focus on building new, which they might have done previously. Skills and labour, I think, is quite self-explanatory. I've told you that lots of people are leaving the market, so lots of skilled tradesmen are leaving the market and will leave the market in the coming years. We're struggling to get people in. We basically need to put right the labour force that we have. So retrofitting, repair, particularly around energy, requires very different skills to the types of work that was done in the past. So we will need a big retraining scheme and obviously a big recruitment drive as well that we have been very unsuccessful at the moment. From a policy perspective, I was quite disappointed with the budget yesterday that there wasn't really much reference to anything other than some of the tax changes that they're going to make. So I'm really looking forward to the bill that is, to use the previous presenter's words, a year and a day old. I'm really looking forward to that becoming law and hopefully starting to see some of the implications come into play, because if they don't, if I stand up here again this time next year, I'll be saying the same thing, that all of the headwinds are still there and nothing has changed, unfortunately. And then from an economic perspective, obviously, if construction pipeline's getting smaller and new work is getting smaller, it means that construction will contribute to a lower proportion of the GDP for the UK. And I would imagine as well that housing growth would probably slow, so then housing prices, you would presume, would go up. So getting a bit more detailed again, so as I said, I kind of drill down a bit. So this chart's looking at planning applications, just as a raw number. So when Barbour looks at planning applications, although we have this data, we exclude anything that is a single unit development, so one house being built on off the back of somebody's land, for example. We exclude that in our analysis. And we also exclude any planning application that's under £100,000. So basically what you can see, if you look sort of to the middle of the chart, you can basically see that the number of applications has been trending down year on year for about the last 5 years. So obviously the economic headwind that we spent a little bit of time labouring a moment ago, that we're facing into, is just not a particularly positive backdrop to be speculating. And there's a lot of speculation in construction, build to sell, build to make a profit. If you look to the right of the line that I put on the chart, so in 2026 we've basically got 3 possible outcomes. It gets worse, it stays the same, or it grows, right? It's not massively insightful, but I suppose what I would say is I'm probably standing here today, I would probably bet something on probably a little bit worse or staying the same, somewhere in there personally, in terms of application numbers, remembering that an application can go in yesterday but not be built for 18 months, okay? It's worth noting as well, just as I kind of alluded to, I will talk a little bit about Gateway for a moment now, so the building safety regulator. About 10% of all of the applications, so each year, each bar, about 10% of that bar. If Gateway had existed 10 years ago, about 10% of those applications would have to go through the Gateway process. So you get a feel for the volume of applications that are going to have to go through the building safety regulator and the Gateway process, and therefore how much of a challenge that's going to be for that regulator. So this chart is showing the average amount of months between application and approval. So you put an application in, the next day you get an approval, that would be 1 day, but this is in months, okay? It's basically showing you that since 2021 until the second half of 2025, it's crept up by about 3 months, so 9 to 12 months. So that's basically, and this is just residential applications. So an average residential application has seen an increase of 3 months in order for it to be basically approved. And that correlates almost to the day with the building, the first of the gateways coming online, and gradually as the additional steps in the gateway have come online, what we've seen is that downstream, after the application has been approved, there's an additional 6 to 9 months delay for the project to conclude because of the hoops that the applications have got to jump through. So it's not really a surprise that businesses are popping up that are helping people navigate, or business units that are popping up to help people navigate the gateway process. I might be preaching to the choir here, reading the room, but I was speaking to a developer in central London a few weeks ago, and these numbers were just unbelievable to me. So I'll just quote them to you guys. But again, apologies. I think some of this will be, well, we know that, Ed. So in a 200-unit development that the developer would be targeting to sell for about £90 million, that would have approximately a £60 million build cost. So they'd be looking to make about £30 million. And let's say that they were funding that with 70% debt and 30% equity. A 1-year delay, which is about what I've just told you is occurring at the moment, a 1-year delay would see them incur about £2.5 million additional interest, about 600k in additional site fees, all sorts of stuff on sites that need paying for, about £1.5 million on the cost of goods because of inflation, and about £2.7 million because of the market having softened in the last sort of 12 to 18 months. So it's about £7 million gone of that £30 million. So it's a massive erosion of the potential profit. And when you contextualise that against the planning application backdrop that I just gave you, it's not a massive surprise that there are less applications going in because it is far less profitable to build at the moment relative to even 5 years ago. Last time I presented at the Landmark Summit, quite a few of the bars on the right of this chart were green. Unfortunately, they're not green today. So this is basically telling us the percentage change in planning applications across the sort of the key regions. There's only one green on there, and it's the northeast, and they've had 11 more applications in the 2 time periods I'm analysing. So don't get too excited about the northeast, unfortunately. So I'm not really going to linger on that just because I'm conscious we're a bit over time, but it's nothing personal. So not much growth across the nation. And then if we look at the sectors, you would expect all of the sectors to be in decline, given what I've been saying, especially with residential, which I'm about to talk about in a moment, also being in decline. So you can see that the number of applications being applied for is in decline across all of the sectors. The ones that are most harshly affected, so hotel, leisure and sport, education and commercial and retail, they have kind of a double dip effect of also being impacted by things like the cost of living crisis, the government's changes to international students, making it less favourable to do development on universities. There's good reason for lots of these things happening. It's not necessarily just a year-on-year timing event with substantial projects happening last year and this year. There's a definite downturn in the market. Now we'll drill down into residential, so possibly the most interesting bit for many of you today. So this chart, again, it's the same principle. So it's the number of planning applications in yearly blocks. And basically, we've seen a decline in housing from 2023 to 2024. 25 isn't on there, but it's the same trend in 2025, just a kind of an erosion of, or a bleeding of the number of applications that are being put in. This is obviously with the backdrop of 1.5 million homes that Labour has kind of set out and gone, we want to do that in the first 5 years. I think they could do it, but not in this 5 years. There's a lot of groundwork that needs to be done in the next 2 to 3 years to get anywhere close to being able to do 1.5 million homes. Obviously, private development's the biggest segment of that, biggest segment of the bar charts, and that's obviously driving the larger portion of decline, which just shows the sentiment isn't necessarily there at the moment, whether it's demand or the profit that's available to be built. There's probably a lot more to be said on that than I'll say at the moment. It's my favourite chart in the whole world. So, absolute nerd. So, application volume and unit dynamics. So, the lower axis is the number of applications, and the y-axis is the number of units. So, basically, if you look in the centre of the chart and just follow the line round, you can just see the year on year on year on year on year dynamic, where moving in this direction, bad. Moving in that direction, bad. Moving in that direction, very bad. And the market has moved in that direction. Yeah. So it's obviously quite a difficult situation. Something that kind of it gets lost a little bit with the chart, so I'll just call it out. If we had the same number of applications in 2025 as we had in 2022, because of the decline in the average number of units per application, we'd have 75,000 less homes in those blocks of applications. So there's, you know, a bit of a risk kind of on the horizon, and I'll elaborate on that in a moment. Appreciate that many of you weren't at the last landmark conference that I did. So this little thing here is another slide in another deck that I did at that conference. So if you want to see that, just drop me an email. You'll see my contact details in a moment. But basically, that tiny little chart is showing completions that have happened, housing completions that have happened over a long time. And then the lines are basically 3 scenarios where if they want to get to 1.5 million homes, if they did it in a flat line, if they did it in a building line, or if they did it in a, you know, an even more building line. But you can basically just make out that the lines look a little bit ridiculous, you know, in contextualizing it against that. And that's really what comes across when you look at the actual data on the chart here. So that this chart is showing housing starts on the lower axis and housing completions on the vertical axis. And again, it's 4 years of decline in both instances. Can anybody do the quick maths? That is, how many houses would you have to do every year, just equal years, to do 1.5 million homes in 5 years? How many homes would you need to do a year? Not a trick question. Yeah. What's the axis? Look at the top of the axis. Yeah. So housing completions. Yeah. Everyone's getting the point here. So we would need to see completions. Bearing in mind we've already had a year, we would need to see completions in the region of 300,000 every year for it to be a flat line. And this axis is, you know, I've not doctored the data. This is the ONS data for completions. So it just hammers home 1.5 million was possibly a bold claim based on where we are today. New reform, new people, new processes, we might get there. Yeah, we might get there. Final point, and I feel awful for kind of being quite gloomy, but here we're putting together effectively the start and the end of the chain. So the number of applications going in, which is the red bar, so we spoke about that being in decline, and the number of units coming out. Now obviously lots of stuff goes on, land banking and you know, deferral of work and all that kind of a thing, but what it's showing us is that we've been pretty consistent as a nation in terms of the number of completions, although there has been some decline, but we're pretty consistent, bar COVID year. The number of applications is declining. There will come a point where completions will start to decline because simply because the backstock of applied for units just won't be there anymore. So we really do need to see a return to growth in terms of applications, and I think we probably needed a bit more stimulus than the government has kind of stated that they're going to provide. Obviously earlier in the spring and then yesterday in the budget. And then infrastructure is probably not super relevant to you guys, although infrastructure is required for houses, right? You need a good infrastructure around houses for them to be appealing. So infrastructure is probably the one thing that I do feel quite positive about. Obviously with the establishment of NISTA, which is the National Infrastructure and Service Transformation Authority, I think that is a great initiative because the government historically has had one group of people over here saying, what are we going to build? And one group of people over here going, how are we going to do it? And they didn't talk to each other, so they didn't build anything. Whereas now that's happening under one new roof, which I think is an excellent change for obvious reasons, should allow us to address a lot of the problems that have occurred. £725 billion, they didn't say there were going to be any cuts to that yesterday. There's nothing in the budget around that at all. So there's still, in theory, £725 billion being pledged to infrastructure for the UK over the next 10 years. That's going to be full of renewable stuff, utilities and water. It's all really, really positive if we can get that going. So therefore, new build and RMI, probably both going to see a lot of infrastructure work in the next 12 to 18 months, but other sectors, unfortunately, probably looking a little bit bleaker. So that's it from me. If you scan that QR code, you go straight to my LinkedIn if you want to connect. I put the occasional thing like this on LinkedIn if you found it vaguely interesting. If you didn't, well, that's life. Thank you.